Hello, I'm Graeme Bibby, Chief Investment Officer, and here with me today is Matthew Leong, Portfolio Manager. We're here to give you the investment outlook for the last quarter of 2024. To start off with, I'll give you a bit of a view as to what we're seeing from the macroeconomic standpoint. Inflation, to start with, has been moderating globally, and we've seen that trend continue. It's declined to a level where the Federal Reserve is comfortable enough to have cut interest rates by 0.5%, and they're likely to keep that trend of cutting rates. We'll see the RBA likely cut in early next year and somewhat lagged due to our lagged inflation. Economic growth has slowed. It's stabilised though, still positive around the world, and we'd expect the US and Europe to pick up somewhat from here, but Australia to be somewhat challenged. We've seen a bit of a negative trend in economic growth. We'll also touch on the labour market and what's happening in liquidity and money supply globally. With that in mind, Matt, what are we seeing in the labour market?
Yeah, thanks, Graeme. So this chart here shows you the US labour market. The white line is the unemployment rate, which we have seen as rising. There were a couple of scares in the market earlier in this just past quarter, with markets selling off on a little bit of concern that we may potentially be going into a recession. However, our view is that although the unemployment rate has ticked higher, and we're seeing 4.2% in the US now, we have seen job net adds have been positive throughout this whole period. And what that means is basically we're actually seeing an increase in supply of labour from migration, from people coming back into the workforce and things like that, rather than a contraction in demand. So we're not really seeing a whole bunch of firing coming through, people losing their jobs. So as a result, we do think that although the labour market is weakening a little bit, it's not signalling a recession. The trend is similar to what we see in Australia as well, with the unemployment rate rising, but job ads are still pretty positive. And over to you, Graeme, what are we seeing in money supply?
Well, in money supply, probably a good picture of that is the US, and this is money in bank accounts and checking accounts and really ready cash that's available to be deployed. And it's a measure of just money that's available for financial assets and purchasing goods and services in the economy. We've seen a contraction in money supply through the middle of this year and previously early into last year as well. And we've got the zero line here, so it's really been negative in that period. This reflects some contraction in government spending and some contraction particularly in banking, loans and consumer spending behaviour. But we've seen quite a pickup in the recent few months, and this is from about March onwards. It starts to rise, so we're seeing a positive trend in money in the market, and so that is supporting equity markets in particular.
All right, and I guess in terms of our equity outlook in our view, our current positioning is quite neutral. We have seen valuations tick up with the rally in global equities as well as Australian equities, so valuations are a little bit above historical averages. We don't think equities are cheap, however, they can continue to rise if earnings continue to grow. So what we're seeing is our base case is that earnings will continue to grow if we are able to avoid a recession, and that is our base case at the moment. A little bit more recently, we have seen China pivot to a bit more of a forceful stimulus program, and markets have started to price this in. We've seen a very, very sharp rally in Chinese equities and Australian materials. So this chart here shows the white line being the Shanghai index, and the blue line here is the ASX materials sector. Both of them over the last couple of weeks have spiked up pretty sharply on news of increased Chinese stimulus. We see this as supportive for markets in the near term. However, we do need to see this start to flow through to the real economy in terms of consumer confidence and global economic activity, which we haven't quite seen just yet. But if this does impact the real economy, we should see this rally sustained. And within fixed income and bond markets, what's happening there, Graeme?
Well, we've seen a decline in cash rates, with the US, and that's flowed through to bond markets with the anticipation of further cuts. So we've seen 10-year government bond yields decrease, and we've seen credit spreads remain reasonably stable. So that's been very supportive for bond indices and the performance of bonds. So we still see that benign outlook for bonds and more support for fixed income.
And in private markets, just to give it a bit of background, we haven't seen that much IPO activity. We haven't seen much listings over the last year or so. How does that impact private markets, and what opportunities are we seeing over there?
So in public markets, there's been two trends. One is the more cyclical, which has been that there's been less IPO activity. The other major trend is the number of companies that are listed on the stock exchanges have declined, and that reflects a lot of companies staying private for longer. So in private markets, that means that there's opportunities still there as IPO markets haven't been an exit. So there's been more activity in secondaries markets, that is people buying from existing buyers who need liquidity. So there's opportunity there, particularly in secondaries markets, and this is one of the best opportunities in the last 10 years to be able to get new exposure into these markets.
All right, so it sounds interesting in private markets. Watch this space. We are looking at a few opportunities. That's a wrap for our outlook for the last quarter of this year. Hope to see you at the next one.